Hello everyone, I'm CA Neeraj B. Welcome to my YouTube channel Accounting Buddy. In part 1 of Chapter 6, Accounting Procedures, Rules of Debit and Credit, we have learned 11 topics plus question and answers on these topics. In today's video of Part 2 of Chapter 6, Accounting Procedures, Rules of Debit and Credit, we will cover another 11 topics including 3 illustrations to help sharpen your accounting skills. In the end, we will also have question and answer section to test your knowledge of the topic. Sit back, relax and watch the full video. Let us now learn about impersonal accounts. The accounts which are not held in the name of a person are known as impersonal accounts. Any account other than the personal account being classified as real account or a nominal account is known as the impersonal account. Impersonal accounts are further subdivided into two account types, the real accounts and the nominal accounts. In this slide, we will learn about real accounts. Real accounts are the accounts which relate to tangible or intangible assets of the business except debtors and bank accounts. Debtor accounts are maintained in the personal name of a natural person or a legal entity. Bank accounts are maintained in the name of the bank. Examples of tangible assets are land, building, stock, and cash. And examples of intangible assets are goodwill, trademarks, and patents. Let us quickly learn a little about these three terms. First, goodwill. Goodwill is an intangible asset that represents the value of the company's brand reputation, customer relationships, and other non-physical assets that contribute to the success of the business. It is often considered the premium paid when acquiring a business beyond its tangible assets and liabilities. Next is trademark. A trademark is a recognizable symbol, word, phrase, or design that identifies and distinguishes product or services of a business from those of others. It provides legal protection to the brand's identity and helps prevent unauthorized use by others. The next term is patents. Patent is a legal right granted to an inventor providing exclusive control over the use of the production and the sale of an invention for a specific period, usually 20 years. It protects new and useful inventions, whether they are products, processes, or designs, and prevent others from making, using, or selling the invention without permission. These definitions are just for your information to give a face to the intangible asset terms frequently used. Now the rule of debit and credit for the real accounts is debit what comes in and credit what goes out. In this slide, we will learn about the second impersonal account, that is the nominal accounts. Accounts which are related to the expenses, losses, gains and revenues are termed as nominal accounts. All nominal accounts are a part of the profit and loss account of the business. Net result of nominal accounts is profit earned or loss incurred by the business. Examples of nominal accounts are sales, purchase, salary, rent, and the rules for debit and credit is debit all expenses and losses and credit all incomes and gains. In this slide, let us understand the link between the nominal accounts and the representative personal accounts. If a prefix or a suffix like outstanding, prepaid, or accrued term is added to any nominal account, it becomes a representative personal account. Let us understand this with an example. For example, for rent account, which is a nominal account, if prefix like prepaid or outstanding is added, then the prepaid rent account and outstanding rent account will become personal accounts. Similarly, the income account, which is a nominal account, will become a personal account if the word accrued is added before the income account. Therefore, if the interest account is a nominal account, outstanding interest account and prepaid interest accounts are the personal accounts. Similarly, salary account is a nominal account, while outstanding salary account and prepaid salary accounts are personal accounts. Let us summarize the rules of debit and credit. Always remember, for personal accounts, debit the receiver and credit the giver. For real accounts, debit what comes in and credit what goes out. And in case of nominal accounts, debit all expenses and losses and credit all incomes and gains. Let us practice our understanding with an illustration. Classify the below mentioned accounts into personal, real and nominal accounts. First account is cash. We know that cash is an asset, therefore cash is a real account. Second account is drawings. Drawings are the amount withdrawn by the owners for their personal use. Therefore, drawing is a personal account. Third account is capital account. Capital is the amount invested by the owners in the business. Capital of the owners is always kept in a separate account called the owner's capital. Therefore, capital is also a personal account. Fourth account is bank. Bank account is also a personal account. Fifth account is sales. Now sales is a revenue account and all revenue accounts are nominal accounts. Sixth account is salary. Salary is an expense account and we know that all expense accounts are nominal accounts. Seventh account is rent. Rent being an expense is also a nominal account. Eighth account is purchase. Purchase again being an expense account is a nominal account. Ninth account is stock. Stock is an asset and we know that all assets are real accounts. 10th account is outstanding salary. We know that the salary is a nominal account. However, when prefix word outstanding is added to salary, it becomes a personal account. 11th account is plant and machinery. Plant and machinery being an asset is a real account. Now the 12th account is goodwill. We know that goodwill is an intangible asset, therefore it is a real account. Account number 13 is prepaid rent. Since prepaid is added to rent, therefore it becomes prepaid rent, thus it is a personal account. Now account number 14 is electricity expenses. Electricity expenses being an expense of the business is a nominal account. Account number 15 is discount received. Since discount received is an income, therefore it is a nominal account. Let us discuss another illustration. State the nature of the account and show which account will be debited and which account will be credited. Transaction number 1 is rent received. Since rent received is an income, it is a nominal account. And as per nominal account rule, all incomes are credited. Transaction number 2 is goods purchased. Goods purchased is again a nominal account. And as per the rules of nominal account, all expenses are debited. Transaction number 3 is furniture purchased. Furniture is an asset and all assets are real accounts. And the rule of real account is debit what comes in. Transaction number 4 is capital introduced. Capital introduced is kept in a separate owner's account which is called the owner's capital account. Therefore, it is a personal account. And as per the personal accounts rule, credit the giver. Transaction number 5 is salary paid. Salary is an expense account, therefore it is a nominal account. As per the rules of nominal account, all expenses are debited. Transaction number 6 is of prepaid rent. Prepaid rent is a personal account, and the rules of personal account is debit the receiver. Let us discuss another illustration. State the nature of the account and show which account will be debited and which account will be credited under traditional classification of accounts. Transaction T1 is Tuli started business with cash of $50,000. If we analyze this transaction, the two accounts are getting affected are cash account and the capital account. Cash being an asset is a real account and capital is a personal account. Business has received $50,000 cash and the rule for asset account is debit what comes in. Therefore, cash account will be debited with $50,000. Rule for personal account is credit the giver. Therefore, capital account will be credited with $50,000. Transaction T2 is goods worth $8,000 are purchased for cash. The two accounts involved in this transaction are purchase account and cash account. Purchase being an expense is a nominal account and cash being an asset is a real account. Rule for nominal accounts is debit all expenses. Therefore, purchase account will be debited with $8,000. Rule for real account is credit what goes out. Therefore, the cash account will be credited with $8,000. Transaction T3 is goods are sold for $18,000. The two accounts involved in this transaction are cash account and sales account. Cash being an asset is a real account, while the sales being revenue is a nominal account. Rule for real account is debit what comes in. Therefore, cash account will be debited with $18,000. Rule for nominal accounts is credit all incomes. Therefore, sales account will be credited with $18,000. T4 transaction is salary of $4,000 paid in cash. In this transaction, the two accounts which are affected are salary account and cash account. Salary being an expense is a nominal account, while the cash being an asset is a real account. The rule for nominal account is debit all expenses. Therefore, the salary account will be debited with $8,000. Rule for real account is credit what goes out. Therefore, cash account will be credited with $8,000. Transaction T5 is an amount of $2,000 cash is deposited in the bank account. In this transaction, the two accounts involved are cash account and bank account. Cash being an asset is a real account. However, the positive bank balance by nature is an asset. However, under traditional classification of accounts, it is a personal account. The rule for personal account is debit the receiver. Therefore, the bank account will be debited by $2,000. The rule for real account is credit what goes out. Therefore, cash account will be credited with $2,000. Transaction T6 is goods worth $8,000 are sold to Polly. The two accounts affected by this transaction are Polly's account and sales account. Polly's account is a debtor account as the goods are sold to him on credit. Polly is a personal account and sales is a revenue account, therefore it is a nominal account. The rule for personal account is debit the receiver, therefore Polly's account will be debited with $8,000. The rule for nominal accounts is credit all incomes and gains, therefore sales account will be credited with $8,000. Transaction T7 is depreciation of $4,000 is charged on building. The two accounts affected by this transaction are depreciation account and building account. Depreciation being an expense is a nominal account, while the building being an asset is a real account. The rule for nominal account is debit all expenses and losses. Therefore, depreciation account will be debited by $4,000. The rule for real account is credit what goes out. Therefore, the asset account will be credited by $4,000 as the value of the building will be reduced by the amount of depreciation charged, which is $4,000. Let us now learn the classification and rules of debit and credit of accounts under modern classification of accounts. Under modern classification of accounts, Accounts are divided into 5 categories: asset accounts, liability accounts, capital accounts, revenue accounts, and expense accounts. Let us first discuss about asset accounts. Asset accounts are those accounts which are related to the resources owned by the business that have economic value. Land and building, plant and machinery, furniture, cash, and stock are few examples of business assets. Rule of debit and credit for asset accounts is: debit the asset accounts when the asset value increases and credit the asset accounts when the value of the asset decreases. Next is liability accounts. Liabilities represent obligations the company owes to the outside parties. Liability accounts include accounts of lenders, creditors of goods, outstanding expenses, etc. Rule of debit and credit for liability accounts is: debit the liability accounts when they decrease and credit the liability accounts when they increase. The rule of debit and credit for liability accounts is exactly the opposite of the rule of debit and credit for asset accounts. Let us now talk about capital accounts. These are the accounts of the proprietors, partners, or shareholders who have invested in the business. These includes capital, drawings, and retained earnings. Rule of debit and credit for capital account is: debit capital accounts when they decrease and credit capital accounts when they increase. Now let us understand revenue accounts. These are the accounts of the incomes and gains. Sales, interest received, commission received, discount received, bad debts recovered, etc. are some of the examples of revenue accounts. Rule of debit and credit for revenue accounts is: debit revenue accounts when they decrease and credit revenue accounts when they increase. The rule of debit and credit are same for both capital accounts and revenue accounts. Both capital and revenue accounts are credited when they increase, while the capital accounts and the revenue accounts when decrease are always debited. Now let us understand expense accounts. These are the accounts of the expenses or losses incurred in carrying the business. Examples of expense accounts are purchase, salary, wages, rent, and depreciation accounts, etc. Rule for debit and credit for expense accounts is: debit expense accounts when expenses increase and credit expense accounts when the expenses decrease. Let us summarize the rules of debit and credit under modern classification of accounts. For asset accounts, debit when assets increase and credit when assets decrease. For liability accounts, debit when liabilities decrease and credit when liabilities increase. For capital accounts, debit when capital decreases and credit when capital increases. For revenue accounts, debit when revenue decreases and credit when revenue increases. For expense accounts, debit when expenses increases and credit when expenses decrease. Therefore, from the above table, it is clear that liability, capital, and revenue accounts are debited when they decrease, and these three type of accounts are credited when they increase. While for asset and expense type accounts, these type of accounts are debited when there is an increase, and they will be credited when they decrease. Another way of understanding the rules of debit and credit is through accounting equation. Assets of the business are always equal to the liabilities and the capital of the business. Through below tabular form for each type of account, let us further strengthen our understanding of the accounting rules. First, asset accounts: debit when increase and credit when decrease. Second, liability account: debit when decrease and credit when increase. Third, capital accounts: debit when decrease and credit when increase. Profit earned and loss incurred increases or decreases the owner's equity. Therefore, for expense and loss accounts, debit these accounts when they increase and credit these accounts when they decrease. For revenue accounts, debit when revenue decreases and credit when revenue increases. Let us test our understanding with an illustration. Mention the nature of the account and which side will increase if the transaction is recorded. First account is building. Building is an asset and they are debited when increase. Second account is rent. Rent is an expense account and expense account are debited when they increase. Third account is sales. Sales is a revenue account and the revenue accounts are credited when they increase. Fourth account is creditor. Creditor is a liability account and liability accounts are credited when they increase. Fifth account is proprietor. Proprietor account is a capital account and the capital account are credited when they increase. Sixth account is stock. Stock is an asset account and assets are debited when they increase. Seventh account is interest paid. Interest paid is an expense account. Expense accounts are debited when they increase. Therefore, asset and expense accounts are debited when they increase, while the revenue and the liability and the capital accounts are credited when they increase. Let us take up few questions on fundamental rules of debit and credit. Question number 2 on your screens is, what is the effect of a debit on expense accounts? The answer is, debits increase expense accounts. Question number 3, what type of accounts are debited to reflect an increase? The answer is, asset and expense accounts are debited to reflect an increase. Question number 4, what type of accounts are credited to reflect an increase? The answer is, liability, equity and revenue accounts are credited to reflect an increase. Question number 5, what is the dual aspect concept in accounting? The answer is, every transaction has two aspects, a debit and a corresponding credit. Let us now discuss few true or false question and answers. Question number 6 on your screens is, freight inward and freight outward accounts have debit balance. This is a true statement. Both freight inward and freight outward are expense accounts. Question number 7, return inward and return outward accounts have debit balance. This is a false statement. Question number 8, sundry creditor is an asset account. This is absolutely false statement. Sundry creditors is a liability account. Question number 9, bank is a personal account and cash is a real account. This is a true statement. Question number 10, rent account is an expense account and have debit balance. This is absolutely true statement. Question number 11, prepaid insurance is an asset account and have credit balance. This is a false statement. Though prepaid insurance is an asset account, it cannot have a credit balance. Assets are always having a debit balance. That is why it is a false statement. Question number 12, a debit in asset account means increase in asset. This is a absolutely true statement. Question number 13, a debit in cash signifies cash in hand. This is a true statement. In our upcoming video of part 3 in the series of accounting procedures, rules of debit and credit on 18th January 2025, we will further strengthen our knowledge of the rules of debit and credit with 2 more illustrations. We will also learn the process of balancing an account and another 2 illustrations to form the T account. At the end of this video, we will have question and answer session. If you enjoy the content of my channel and appreciate my teaching style, please like, comment, subscribe and share my channel Accounting Buddy. Don't forget to hit the bell icon so you never miss an update. Thank you and goodbye for now.